Alright, so today I'm gonna make a video on moving averages and how to use them for trades, stop losses, all that sorts of stuff. It's kind of what I did in my first, I don't know, 6 months of swing trading. Was just use this formula that I'm about to show y'all. It was pretty profitable. So helps with risk management, helps with stop losses, helps you not lose trades and hold the bag a lot. So let's get into it. So moving averages, the most common ones are 8, 20, 50, and 200. That's the ones I use. I know there's a lot of other people that use like the 9, the 21, 70 something, I don't know. But 8, 20, 50, 200 really hasn't failed me. I'm going to turn off the 200 for right now and just focus on 8, 20, and 50. We're going to use AMD today as an example of kind of like entry and exit points, how we can check trend and momentum. So moving averages, they're kind of here to help smooth out price data over a long period of time, over 8 days, 20 days, 50 days, 200 days, and kind of gives you the average of the price of the stock. And so the 8-day, which is I think red, 8-day is a momentum check. So I use the 8-day as to basically check the momentum of the trend. So if it's going up, it's in a momentum of upwards, but if it breaks it, now it has no momentum to the upside. Now it's going to go back down to the 20-day, which I use for a trend check. So trend checks are used for like checking, alright, lower highs or higher lows, and maybe helping hold just a little bit longer so it can bounce off this 20 and then go a little bit higher. Then I use the 50-day for entry and exit points. So let's just kind of go through an example here. I'm going to turn off the 8 and the 20. So we're just going to focus on the 50. So the 50 is where I enter. So I'm looking at this trade. I'm looking at it. Alright, it's below the 50, so I'm going to check it. And I always do the trade. I take a trade based off the closing price. I don't want to get faked out by these wicks that go below it and then lose all this uptrend. So I'll risk a couple percent just to wait for that closing price to see what happens. But here I would enter at this candle for the 50-day, and so once I enter, I'm turning on my 8 and my 20. So it goes above the 20. So that's our trend check. So it's going up, 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 staying above, staying above, staying above, and now we are at the 8-day. 8-day I said was momentum. So basically, after it closes the 8-day, I'm taking 30% here. I'm taking 30% profit, just because you're losing momentum if you lose the 8-day. So if you're losing the 8-day, you're probably going to go test the 20 or whatever, the 50, the closest MA that's closest. So we're still up. We're over the 8-day, and now it goes back down below the 8-day, and now we're taking another 20%. And now it can't get above the 8-day. Now we're closing our full price, our full trade right here. Once it breaks this 20-day and 50-day. So you had a nice run to let's see, nice run from 79. You took profit at 84 and 84, so that's a 7-point swing, 30% at both, and then you took full profits at 82 from 79, which is 3 points. So I mean, you made good on that swing trade. This is mainly for swing trading. Maybe like 3 or 4 trades It depends on how many stocks you do, but how many entries and X's. But these don't last multi-months or however long. These are mainly week-to-week trades you're doing. And so now that's below the 50 again, and we're just gonna wait. Never gets above it, tries to fake you out. Still is not above it. It's right on it, but it's not above it. And then it opens right below it the next day, so I'm not taking that. That's why I always like to wait for the closing price. And that's also not a bullish candle, so I'd be iffy on taking that. I would wait till the next day for entry, and the next day it didn't get above it, stay below it, below it, below it, below it, below it. And now I would say entry here. So once we have entry here, put it on my 8 and my 20. Green bar is 50, so we take it here. And then our stop loss is the 50 again, since we are above the 8, or since the 50 is above the 8 and the 20. And we would actually have a losing trade from 82 to 81, so you lost $1 on however many shares you bought. It's not that big of a deal. It's called risk management. So it's below the 50 again, and now it faked out a lot of hands, and now we're entering back in 81 the next day. So we're putting on our 8 and our 20, and it stays above it, stays above it, stays above the 50, and we're still riding, we're still riding, we're still riding, and then it breaks below the 8 day at 92 from an 80, so that's a 12-point swing. I'm taking 30% there. It tries to go to the 20, but it's too strong, so that's basically my trend check. Remember, the 20 days my trend, 8 days my momentum. So we're still in a higher low. We still go up, we go past the 8 day, and then we're still above the 8 day, and then we take profit again at 93, probably 30%, and then it breaks the 20 day, and we're out fully here. So that's a good, from here to here, that's a good good profit, good trade on a swing. Probably 2 weeks to develop that. I mean, you can do this all the way down. Just keep setting your 50 days your enter, your 8 days your momentum. If it breaks the 8 day, you take profit, a little bit of profit, and then if it goes above it and breaks below it, take another little bit of profit. But if it breaks the 20 day, you take full profit, because that's breaking the trend. It's going to retest your 50 day, most likely. If not, then it kind of sucks. But anyways, but that's kind of like what I did for swing trading back in the day. Now there's the 200 day, which a lot of investors that have a lot of money, have a lot of time on their hands, they buy at the 200 day, because the 200 day is like the biggest support for any traders. So usually people will buy at the 200 day dip. Buy here, sell here, because if it breaks the 200 day, you don't want to trade below the 200, because below the 200 is bearish, above this is bullish. So it breaks above, you buy here, sell here, buy here, sell here, buy here, sell here. See, look at all this manipulation. Buy here, sell here. So you're not really making much, you're kind of frustrated, you're waiting, and then you buy here again, you buy the test again, and now you're up pretty good. And you probably wait until it crosses or it touches it again. A lot of investors like to use that. A lot of investors like to do the golden and the death cross. So the golden cross is when the 50 day crosses the 200 day, which we just had on AMD, and the death cross is when the 200 goes over the 50 day. So a lot of people like to not touch it when the 200 days above the 50, and then once the 50 crosses the 200, that's called a golden cross. That's a bullish indicator, and look what it did. It went crazy. You could have You could have bought it here again at June 8, 2018 and rode the 50-day all the way up to now, April 2021. So you can see how the Golden Cross keeps your hands, not paper and diamond. And then you just buy right here again. So Golden Cross, Death Cross, that's another good one. But that's kind of all I got for today. Just a quick little lesson on moving averages, kind of how helpful they are in swing trades, and how to help keep those paper hands diamond, and have good stop losses and risk management. And yeah, I'm probably gonna do more educational videos just to help y'all. And if you can master how to use the moving averages, and you can master how to use the RSI, you can master how to use a lot of other indicators, and you can bring it all together, and that's when your trading starts to become more and more better. And you add a little wave theory, add a little Fibonacci trading, add pitchforks and pennants and all sorts of stuff. So this is the first of many, but yeah, that's all I got for you today. Peace.